Okay, let's get started. I want to thank the community for tuning into this conversation with Jason Hirschman. I look forward to doing more of these types of conversations. I think we have two more that are queued up over the next couple of months. And just as a reminder, if you're part of the MicroCap community, you can tune in live to these and ask questions, with the speaker that we have on, which I think is a unique experience. But before we get started, I want to remind everyone listening to this live and to the recording, the purpose of this conversation is for informational and educational purposes only and should not be construed as a recommendation to purchase or sell any security. MicroCapClub is not a registered investment advisor. MicroCapClub, its partners, members, subscribers, affiliates, friends, family, may or may not hold positions in one or more of the securities mentioned on this program and may trade in such securities at any time. Do your own due diligence, seek counsel from a registered investment advisor before trading in any security. And so just an introduction to Jason Hirschman. As many of you know, Jason is an individual investor who I look up to and have looked up to for quite a long time. And, he hates when I say this, but I'll say it for the third time in the last 24 hours. He's really is on my Mount Rushmore of private investors.
Ooh.
Yeah. He's a small business owner that kind of parlayed that and some investing success into just being a full-time private investor and now managing capital for his family office at Hudson 215 Capital. And, it's an honor to have him with us today. And I think you've been a member too of MicroCapClub since 2014 as well. And you have, not only are you a unique investor and a good one, but you have a unique posting style in our club, which I know if you're part of the community, you would appreciate. So thanks for joining us.
Oh, thank you, Ian. Really appreciate it.
Well, I hate to start out at the very beginning, but I'm genuinely curious about your background. Things like, where did you grow up? What did your parents do? Where did you go to school? Things like that.
Sure. Ian, no one would have expected me to be here when I was young. At 5 years old, I could only say about 20 words total. I would just point to things and nod my head. Schools thought I was way below average intelligence. Later they realized, okay, I was smart, but I would get into fist fights with the other kids in elementary and middle school, even on a bus on the way to summer camp. I cursed out a rabbi at age 12, but I had the best parents. When we met with the rabbi later on, my mom told him, yes, Jason should not have cursed you out, but he's not wrong about you. So my parents always had my back. My mom and dad, they met in the Peace Corps in the late 1960s, but in an unusual manner. My dad was originally assigned to the country of Colombia, but his manager insisted he shave his beard. Right? Only communists have beard, which is so stupid. My dad refused because he thought the request was ridiculous and was shipped back to the USA for being mentally unfit. He risked being drafted into Vietnam, which he desperately wanted to avoid. Just because he refused to be clean shaven for a couple of years. By pure luck, Dad was sent to a Peace Corps psychologist before he was drafted, who told him that he was definitely crazy, but not mentally unfit. Right? So he was reassigned to Panama, where he met my mom, and here I am. I literally exist because my dad refused to shave his beard. So my mom, she was born 1 year after her parents were released from a Japanese internment camp in Arizona. Right? When I was young, we lived on Long Island. My parents ran the family business, a small manufacturer and distributor of eyewear frames. My memories of kitchen table discussions, I think starting at age 7 or so, are a litany of small business challenges like thefts, employees pulling knives, corrupt optical unions, bankruptcy risk, embezzlement in Korea, big bets on products, big successes, big failures, pension problems, IRS audits, you name it. So I was raised not to compromise, that you can't trust authority figures, that you have to be tough, and you have to expect volatility and pain in life. Basically, I was raised to be a microcap investor, right? So, but that's just the stereotype, right, of a microcap investor. All of us at MCC know that in reality, microcap investors need to master the ability to team up with others, right? They need soft qualities, things like patience and introspection.
That makes sense. So what were some of those kind of first formative moments for yourself when it comes to investing? I remember I think you even tweeted it out not long ago, some of your initial, was it MasterCard or something like that you bought really early on? Like,
Yeah,
so
that
you,
was MasterCard was like 2006 and things like that. Initially I started out just, it was silly. I started out as a technical investor, right? I was looking for doji stars and all those other things. But it came clearly to me very quickly that becoming a fundamental investor was the answer. And I was very lucky because of a particular person who got me interested in investing
and,
in a broader sense. In a broader
yeah.
sense.
And who was that?
Actually, well, that was Peter Lynch, because Peter Lynch was my high school graduation speaker, right? Which is very, very lucky, very fortuitous, right? So therefore, I picked up a copy of One Up on Wall Street very early in life. I'm dating myself, but Roger Lowenstein also published, I think, Buffett: The Making of American Capitalists in 1995, just as I was graduating with an economics degree from the University of Chicago. So after a very short stint in consulting, I rejoined the family business, third generation. I'd always worked there during vacations and in the summer. At 14 years old, you may have been on the golf course, right? But I was in the warehouse figuring how to turn inventory quicker, right? So therefore, later on, when I was 24, even though my parents had 25 years more business experience than me, they trusted me to make big business decisions. Remember, my parents they're just built different, with little regard for like traditional pathways. So I could see at age like 24, 25 that the prescription safety eyewear business was just a slowly dying market. The only way to safeguard my family's financial future was to take what little excess return we could generate and invest that in public equities, because I didn't have time to manage more businesses. I worked quickly as possible just to relocate the business from like Long Island to a cheaper Las Vegas, came up with a few patented products, prioritized gross margins, moving them from the mid 30s to the mid 50s inside of 10 years, reduced working capital, whatever it took to produce any free cash flow. In 1995, and of course, this is like back in the day, right? 1995, the S&P 500 return was 34%. I think it was 20% in 96, 31% or so in 97. It's amusing in hindsight that I lacked like the investing common sense just in early 98 to see that this was like an unsustainable path, right? But by the time I realized that in 1999, I already caught the value investing bug. I was buying Berkshire Hathaway and other value stocks going into the 2000 tech crash. I owed a lot, ironically, to like the exuberance of the tech bubble.
Do you remember sort of the first big win that you had in the stock market?
It's hard to remember the first big win, but I think
there's just been so many, so it's just
no. I mean, really, it took time to really, to get it together. But I think the first early investment that I remember and want to highlight was probably the most important investing lesson in my career, and that was Diamond Hill, right, which was a early financial win for me and my family, but a long-term opportunity loss. DHIL for those who don't know, it's a publicly traded asset manager. When I spotted it coming out of the tech recession in 2002, its market cap was less than $10 million. Now it's over 400 million. And I did all the right things, Ian, right? I talked to management, made a model, visited the company. In fact, I was the only outside shareholder to the annual meeting in Columbus, Ohio, at least outside, like just greater Columbus, Ohio. I bought 13,500 shares at $3.84 or so, which was $51,000, a large chunk of my portfolio at the time. Diamond Hill now trades at around $150 a share. So I sold it after a year or so with a good gain, but left almost $2 million on the table, plus over $1.8 million in dividends on that $51,000 investment. And why did I sell? To refinance a mortgage and get under the jumbo rate, right? I avoided the jumbo mortgage, so mission accomplished. But I ended up with a jumbo investing error. But frankly, the early big win or wins for a young investor it's not measured by the most capital gains, but the insight you get and the motivation you have for like improving your investing approach, right? That Diamond Hill experience, like it tattooed on me the importance of holding onto superior businesses in the early innings, which I did put to successful effect in the future with MasterCard in 2006 and later with XPEL, right? Because we all know for a stock to become a 100-bagger, it has to double roughly 6.55 times, right? And there's a lot of tension between like holding on for more upside and protecting your gains. I'm sure we'll talk about this more when we chat about XPEL.
Yeah. So what would you say your first, when did you start looking at microcaps kind of in earnest? Like what time period would that have been?
I went in and out because when I started, and you know this for yourself, there really wasn't as many online resources as there were back then, right? So in part, I was learning and I gravitated to like the Motley Fool like discussion boards. So that was probably my little locus, my little community. But they weren't necessarily focused. At least the best boards weren't necessarily focused on microcaps. So I flirted around with microcaps at Diamond Hill. I had some losses in like EVCI, which was like a small microcap publicly traded education stock that blew up like so many other big education stocks. There's some others, but honestly, it probably wasn't until maybe a couple of years before, or even a year or so before, I joined MicroCap Club that I really, started really, solidly focusing on microcaps.
And how have you kind of handled that transition? I know you still own non-microcaps, large caps, if you will, too.
Absolutely.
How do you manage that now as a family office, sort of the breakdown between kind of these more liquid, larger cap opportunities and kind of microcaps as a whole?
I think I spend 90% of my time looking at microcaps or small caps. And the other opportunities, let's say like a Facebook opportunity, for me, they just they come when they come. I can't really do any sort of unique due diligence. It's just about having like a different perspective on it. So when it comes to these large cap, mega cap opportunities, I'm either waiting for just a general drawdown in a particular sector or in the market. But I spend 90% of my time on microcaps these days.
And when you grew your capital, from 100,000 to 1,000,000, 10 million, 100 million, talk a little bit about how the game changes, how you've had to evolve and grow with your capital as it grown. What are some of those areas?
Sure. Yeah, sure. Even with a substantial XPEL pullback, right? We're over 100 million in equity assets, right? And I realize it's a fortunate problem to solve, but for microcaps, we need a microcap investment to get to like $10 million in 5 years or so. Otherwise, it's a too small position. But if you think about it, to get to $10 million, like 1.5 million must compound at 46% a year for 5 years. A $4 million investment only needs to compound, let's say, a 20% rate over 5 years to get to 10 million. Of course, one's willingness or my willingness to invest 1.5 or 4 or some other number, it really depends on the risk reward. Okay, let me, if you don't mind, let me just use a hypothetical, right? Let's say a microcap with like a $90 million market cap is trading at 2 times book, no net debt, and is like half owned by management and other like tight shareholders. Okay, therefore, we need to purchase like 4.5% of the remaining shares in circulation to establish a $2 million position. Now, let's say over 5 years, this microcap goes from break even to earning like a 25% return on equity in year 5, right? So 5, 10, 15, 20, 25% ROE in the final year. Certainly, if growth prospects continue to be strong with expectations of, let's say, 3 more years of a 25% ROE before the returns fade slowly, this microcap could trade at 25 times trailing earnings or higher at the end of year 5. So end of year 5 book value of this hypothetical company is 90 million now, and it just earned 18 million in net income. So that's a $2 million Hudson 215 capital investment that turns into 10 million, putting aside stock options and a few other factors, right? But what's crucial, I think, for like investors to understand is that this microcap needed to find places to reinvest at excellent incremental returns, $45 million over those 5 years, right? Which is the same amount of equity it started with. Not only that, But if this microcap earns a 25% ROE over the next 3 years, let's say years 6 to 8, it would create another 85 million for reinvestment. And so, thinking about it, like how many microcap management teams and TAMs can support that? So our qualitative work for microcaps, in essence, is designed to help solve this quantitative challenge I just discussed, right? Number one, understanding the business sufficiently to minimize the downside of illiquidity and management execution risk. And number two, understanding the upside early enough to get like sufficient money, like, in the early innings, right? I'm older than most microcap investors and say have significantly more capital to deploy. So how do I turn age and wealth into an advantage in microcaps? Well, because my wife and I are older and have more resources, we can set up our residential base in Europe, right? We can visit companies in person in Europe, not just once or twice, but more to get a better feel for the businesses. So to me, that's turning a disadvantage into an advantage. So we've been spending time in Sweden, where we find higher quality microcaps, profit focused, more reasonable management compensation, stronger protection for minority shareholders, the total package. So from time to time, hopefully, I'm praying for it. We should find more $100 to $150 million market cap businesses with solid runways at reasonable prices.
Well, but I've been following you obviously for almost 10 years, and you are generally drawn to some unique situations that I think in general, at least at their onset, investors, a majority of them aren't attracted to, which I guess that's why there's an opportunity in that equity. Whether it was XPEL at $1 and really doing the work to look into the lawsuit with 3M back then, a lot of work that no one else is willing to do. You did that work. Or whether it's, just investing in obscure places, doing things that might not be attractive, at least today, to the majority of investors, but you're sort of making a bet that the business fundamentals, will ultimately reach a velocity that will attract the next tier of investor into it. So I'm just curious, like maybe tell us a little bit about what types of businesses or situations that you're generally attracted to, and if there are any kind of common elements in them when you think about your portfolio.
Yes, and I think you did highlight one kind of situation we really like, right? Which is a future high ROIC business, hopefully that we can identify that's suffering from a temporary, hopefully non-operational problem, right? Kind of like XPEL. Galaxy Gaming was supposed to be the right thing, but sometimes they don't turn out the way exactly you want them. But I would say that the types of businesses that I want are actually very similar to what other people are looking for, right? Buffett famously said that growth and value were joined at the hip, right? I'm like a million other investors looking for underappreciated or mispriced, underappreciated growth or mispriced value or something that has both those, growth and value, right? It's just the situations that I'm probably heading into, which are a little different. I think in some ways, microcap investors is just a misleading term, right? I really, in some ways, consider myself like a talent scout, right? Looking for amazing prospects, whether high school seniors or like college freshmen, right? Do they have what it takes to make it to the major leagues, right? The dream, of course, is to find that high school senior you sign when he has a broken leg and who develops into a major league superstar, right? But you can't take the analogy too far because the player in this case is a mix of management talent and business model, right? So, but being a former small businessman is definitely an advantage in this case, I think, versus the finance graduate who reads 33 investment books a year and can tell you from memory what Buffett said on page 9, paragraph 3 of his 1998 or 1988 Berkshire Hathaway annual letter, right? These kinds of guys, and not all of them, but I don't think they could spot or trust. Like let's say like a young Rose Blumkin who founded the Nebraska furniture market, right? She can't or she couldn't or wouldn't use terms like ROIC or EBITDA or provide guidance, but she could tell you how she got a great deal on carpet, which she passed on to her customers. I did the U Chicago economics degree. I can build a DCF model with the best of them. You want a pretty investing checklist? If that's what you need, If that's what you want, I can do it. But the best small growth microcap setups, their CEOs haven't learned yet to talk finance, bro. The businesses are a bit strange. The stock fails that checklist. And that's what makes this game so much fun for me is that that break even or low PE microcap with the CEO who just blows my mind with the unexpected response to a random question, like the fifth time I interact with him. Hey Ryan, right? Ryan Pig, tell me about a U.S. submarket that's doing really well, but would surprise people, right? In 2018, Laredo, Texas, a working class border town with one of the highest paint protection film penetrations in the country because dealerships are putting some paint protection film on every new pickup truck. Wow, right? So in 1998, number one, like middle class buyers, not just rich people, will want PPF. Number two, right? Massive dealership success is a possibility. And number three, like XPEL is measuring sales on a per capita basis in submarkets, right? So what do I want? I want a great CEO who doesn't speak finance talk. I want an illiquid or underfollowed grower or cheap stock that is just suffering from a non-operational challenge, like a lawsuit, right? You put those together, and then you have magic.
No, it makes a lot of sense. And I agree. I think it's what makes MicroCap unique, and especially on MicroCapClub too, and on the community is like not everybody has the same kind of trajectory of going to a great school, going to a great MBA program, getting the same Goldman Sachs internship in the investment banking department, and off you go. I mean, I would say some of the best investors in microcap are small business owners, or they were small business owners, and they're the best investors because they know what it takes to grow a small business, and that's what we're all investing in. And ours just have a ticker symbol you can buy in a Schwab account. And I think that's what makes just the space unique. And you get a bunch of qualitative, interesting due diligence and insights because somebody like yourself can give us some expertise into the eyewear market or whatever the case may be. Everyone has a different set of experiences that can be additive to due diligence, which I think is also unique. But anyway, when it comes to kind of position sizing, taking positions, due diligence, I'm curious if you could run through an example, and you could mention an individual name. I mean, you've been public about high up as well or whatever, but I'm curious start to finish what that looks like from when you find something to when you buy something. How long does it take to make the position size? When do you feel like you have enough knowledge to start initiating a position? Because it could take you months to establish one. Do you do that when you feel like you're kind of 60% to all the information you would need, or, kind of runs through the process a little bit?
Yeah, and it's interesting because I've also asked management, like, how do you pronounce HAYPP, right? Is it hype? Is it hape? Is it? I never heard hype, but so be it.
It's a new one.
And they're like whatever the customer wants, as long as they buy. But I think it's hype. So let's use hype group as an example, right? Hype, just for those who don't know, and we have a position in it. Hype is the world's largest online retailer of nicotine pouches. Right? Nicotine pouches are small white mini pillows that like users slip under their gums. Right? These products, such as Zyn, offer nicotine with more than 98% reduced risk compared to cigarettes. A predecessor product called snus is popular in Sweden and has helped Sweden have significantly lowered lung cancer and I think other tobacco-related health issues than other European countries and the USA. So how do we find it in the first place? How do we locate it? We were looking for like the classic Peter Lynch broken IPOs in Sweden and found hype in January 2023. It was apparent to me that the profits generated in Sweden and Norway were being reinvested in growth markets such as the USA. The growth markets were going to inflect into profitability sooner rather than later. I got that all from just the initial readings of their quarterlies and conference calls. Right. I think sometimes Americans look in Sweden or Europe for companies which sort of remind them of domestic USA winners. We reversed that approach, and we wanted like Swedish companies that could claim to be like the Silicon Valley of a particular field. Like in this case, nicotine pouches. So My son Eben spoke with the CEO, Gavin O'Dowd, in February 23. We start buying that same month because honestly, these low liquidity names, it takes a long time. So we start going right away if we have any kind of interest. We visited the headquarters in Stockholm in May. We Zoomed with management in July, in September, and October, all the time just buying. And we visited for a warehouse tour meeting and dinner in November, right? We did more calls in 2024, dinner with management in New York City at LD Micro in April, another visit to the headquarters in early August. Of course, we also had calls with our friends Lawrence Hamptill and others to learn more about the tobacco and nicotine business. We read expert transcripts about big tobacco. We spoke with former Hype employees. We contacted board members, and more, right? So we had lots of internal conversations between me and Eben, my wife Chala, with whom I work with, about Hype and the tobacco industry and the regulatory environment. Eben, he built out a complete multi-year model with balance sheets, income statements, cash flow statements that we could manipulate to see the effects of pushing and pulling certain elements of the business. And it's a lot of work for a position which was established at less than 5% of cost in the overall portfolio, I have to say. And look, we could have gone bigger. I know some young investors on Twitter are very, very enthusiastic about Hype. But what people underestimate is that novel nicotine products and other online nicotine retailing do not have like the long established regulatory history, right? There's bound to be both victories and defeats as certain flavors are accepted or rejected by regulators, and certain online markets are welcomed or with open arms, or firmly rejected or even litigated. So I expect a lot of volatility with this one.
And how did you determine when you were ready to start taking a position? And did you just start buying a position like that in the open market? Do you identify a block that to get you started, or how does that happen?
I mean, I hardly ever find blocks in stocks when I want to buy them. I find that there's blocks that trade well into the time when I have a position, and it's just a question or a process of just chipping away at the position for weeks, for months, for over a year if necessary. So, like I said, we start buying in February 2023. We probably accelerated, even though the price had gone up, let's say in May after our initial visit. And that really, I think, was the deciding factor, right? We walked into their office, and they have a ping pong table in the middle of the lobby, which is not what you think about as a nicotine or tobacco company. So it just seemed to us, this is like a internet retailer that just happens to sell nicotine, right? And also has some special qualities because there's so much regulation around nicotine. So that's the benefit of a visit. And honestly, when we went there, we were one of the first, I think, outside investors to visit, not only from the United States. I mean, I think we were the first one from the United States, but even in Sweden, right? So it always gets your always, as a microcap investor, right? When you hear that you're one of the first to visit the company, it just makes it more exciting.
So when you build a position like that, it's great when it works out, and then you have a big position. What happens if it doesn't work out? How do you deal with that? Do you just kind of view every position you buy, because of the amount of daily liquidity you own, as, all right, we're stuck with this thing, so we better be right at the onset? Like, how do you approach that?
Yeah, I mean, look, getting out of a big position in an illiquid stock, how should I put this? It's like being a fat man squeezing himself through a narrow door, right? It's awkward and silly looking under any condition, but downright painful and dangerous if the house is on fire, right? So we really have to try minimizing being big and wrong. And we'll talk about another Swedish stock for a moment, right? I was very public about Goldberg and Janssen, a Swedish microcap or nanocap, trading on their tiny spotlight exchange. We still own it, although fewer shares now than when I pitched it publicly in 2022. And look, I bought at the wrong time, at the wrong price, in the wrong quantity. But otherwise, I nailed it. So I don't think Goldberg Janssen is terrible, just not as good as I thought. Also, GJAB has faced like macroeconomic headwinds for about 2 years. It's just, and this is the problem, right? This is a stock that if it was a mega cap, I would have blown out of it probably, in a millisecond, like maybe a year plus ago. But because it's a nano cap, and we bought such a substantial percentage of the company, and it doesn't really trade very much. It may take it may be like a 5-year journey from like entry to exit, and that's tough. That's the advantage of private family capital, right? Mm-hmm. So that being said, I think we're going to crystallize a loss of about 140 bips at cost if there's no further stock price improvement and we exit in an orderly fashion, right? So that would be the largest dollar loss and percentage loss in 5 years on a single name, which I think speaks to, in part, to our portfolio turnover and how carefully we investigate new positions.
That makes sense. How important is establishing a relationship with the management team or CEO?
Ian, it's very important, but it's not required, right? There's one company we're building a position right now which does not make their CEO available after like an initial call, right? But their IR rep is excellent. Needless to say, we cannot and do not want to know what the CEO is going to do in the future, right? We're not trying to front run anything. That's just, it's against the law and it's not right. But we do need to know like why he did what he did, preferably with some details, and why he didn't do some other things, right? We also want like a solid CFO. I don't know, and I'm curious about your experience. I don't know if we've ever had great success with a promising CEO who was teamed with a weak CFO. I can't remember one.
No, I mean, I think that's one of the things I've realized too. I think it's probably one of the bigger areas I've evolved in the last 10 years is kind of going from this belief of kind of founder mentality, and you don't need anybody else. Even the right board doesn't matter because it's such a great human being with amazing skills that he doesn't need anybody else to create this huge business. Kind of going away from that and going towards like, no, like you need good corporate governance. You need a board of directors that's additive to the business, to the capital markets. And it is a team effort, especially in the management team, like you said, the CFO. Listen, these are microcap companies. You're already behind the curve. It's hard to be a small public company, on top of running the business. So you can't make it even more of a headwind by having incompetence, at the management level. And that's kind of how I view it.
Yeah, right. And I would say it's not like every employee on this company is always going to be like an A+ employee. I think particularly in a microcap, you're not going to get that. But one of the things I do like talking about CFOs is that they typically don't have the same, exuberant personality that a CEO has, right? They tend to be a little bit more sedate, which I think it just also makes it a little easier to judge the business because they're not naturally spinners, right? So I think it is helpful to talk to both the CEO and CFO at a time.
Getting back to something like XPEL, what attracted you? And I think you kind of answered a little bit of this already. You like the business underneath the lawsuit, and that was kind of the opportunity for you, but what did you think about the potential of the business kind of looking back, then when you were initially making the investment? Did you ever think it would turn into the business it has so quickly today?
I did realize at some point that XPEL had some magic, right? But to be quite honest, like when I first heard of XPEL, when I first learned of XPEL, like in early 2014, and I have to admit, I thought it was the stupidest idea in the world, right? I thought it was an expensive, glorified car condom for big ego men, these kinds of guys with 7 Ferraris and 3 ex-wives, a chalet in Gstaad, a one quarter net jet share. I thought that was like the market. But I didn't want to dismiss it fully, because years previously, like a friend had told me about Constellation Software, right, which another Canadian listed company. And I joked with him that I could see a Canadian roll-up of like maple syrup makers work out. But what the heck do Canadians know about software and rolling them up, right? So obviously, I mean, because of that mindset for a while, I have way too small a position in Constellation Software because of a poor attitude. So I'm a slow learner, but I do learn, right? So what really matters is what my customers and end users think, not me, right? XPEL was growing quickly, practically with no marketing or advertising. That really, when I started looking to it, that really stood out to me. When you see a situation where customers, and in this case, like the direct customers are like independent installers of pen protection film, when they seek out the microcap, when they contact the company and not vice versa, your investing spidey sense should be tingling. So after XPEL was sued by 3M, I had a general sense that the 3M patents may not apply to XPEL because they were like in part based on polycarbonate, which is a UV inhibitor, just like safety eyewear lenses and side shields, ironically enough, right? Once again, going back to like my personal business experience. XPEL's paint protection film did not stop paint from fading according to the marking document. So I had some suspicion things were a little bit off. But the real magic, and I have to thank MicroCapClub for this, because was teaming up with Lock, Stock, Barrel, who I met through MCC, who I always say deserves like 85% of the credit for what we did together, right? Analyzing patents and sending XPEL's film out to like a chemical laboratory to be analyzed, right? Being a small businessman who experienced patent lawsuits as both plaintiff and defendant, we joke, Meredith and I joke that it like qualifies me as a junior associate to like Lock, Stock, Barrel senior partner, right? But just barely. So I added very aggressively after we received that chemical analysis report in the second quarter of 2016. From May through November of 2016, I personally bought 40% of XPEL's volume that was trading on the TSX Venture Exchange. But I think this is important to note, Ian, because I think a lot of young investors do this. I did not go all in, because you can be totally right with a microcap and still lose, right? About 15% of my portfolio at cost was my target for XPEL. And I have to admit, right, there were times I regret that decision to stick to 1.5 million shares, because I was seriously considering 2 million shares in a 20% position. But, c'est la vie. But to get back to your question, I would be lying, absolutely lying, to say that I saw XPEL as a 25 or 50 or 100 bagger at the time. XPEL closed 2016 at $1.45 a share, right? It settled the lawsuit in 2017. Yeah, right? Settled the lawsuit, but suffered a serious quality control issue that same year. When did XPEL close? The end of 2017? $1.40 per share, like 5 cents lower. So, wah, 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 right? All that work, all that investment, and I was down in the first year. But honestly, look, I don't blame anyone for selling down XPEL as it goes up. What amuses me is and what troubles me and amuses me is like how many of my fellow XPEL shareholders sold every time the price broke through like a prominent number, like $5 a share. We lost some XPEL friends. Like $10, we lost even more, right? It was always like round numbers. I used to joke with LSB, XPEL at $9.90, undervalued. XPEL at $10.05, clearly overvalued, right? And in the end, so much has to go right for a microcap to like 25x or more. Like even if the management team, acts brilliantly, even if the TAM grows like tremendously and fabulously, a microcap cannot, control what's like competitors' actions, right? XPEL has succeeded in part because its competitors, mostly manufacturers, were so slow upgrading their tracing software and building out their team of installers.
So you mentioned a few interesting things there, and you're right. Like if you're gonna actually hold on to one of these monster winners, it's a very lonely journey, and I think I've said this a couple times, way too often probably, but like you're gonna have to own something that's cheap, expensive, hated, loved. Your emotions, your cost basis, everything's screaming at you to sell, and that's when you just have to really believe in the due diligence you've done, and obviously the thesis tracking to where you think that there's still significant upside, given an adult time frame, but I'm curious with being involved in XPEL on the way up, and we'll get to the way down a little bit in the next question.
Yes.
But on the way up, like what are you thinking about selling, or what how do you gauge where the equity is today? Are you kind of gauging against where you think the business will be at 5 years from now, and if you're approaching that figure you're going to start shaving some off? Like how do you approach valuation and holding at the same time, and when does something get too expensive?
Well, I do think there's a lot of things that go into position sizing, and everybody, I think, everybody has some limit where if it's too large a percentage of their portfolio, or if it's too high a dollar value, they no longer see the stock and the company as it is, right? They see it as they want it to be. So everybody has to sort of realize that level by which they can't go over. They can't get over. And for some people, it's a 10% position. Some people, it's a 20% position. Some people, it's a 50% position, right? So, fortunately for me, XPEL came, when I was like let's see, 2016, I was like in my like early 40s, right? It didn't come to me. I would not have handled it the same. I did not have the maturity. If it came to me like when I was in my mid 20s or late 20s, there's no way. The other thing is that fortunately for me, XPEL, I just kept analyzing it, just kept seeing the value go up and up and up and up. Another factor is, and it's fortunate, right? Other things in the portfolio have done well, right? So even if XPEL completely blew up, even if XPEL went to zero, I would still, let's say by 2018, 2019, 2020, still have 8 figures in other names, right? Which quite frankly makes it easier.
Yeah, and I think that's important, and you hit on it before in some of your remarks. I think there's a certain misplaced bravado when it comes to talking about position sizing. Like the right position sizing is always more.
Yes, and everybody, yeah, and everybody is glorifies, and I'm a concentrated investor, but everybody, the glorification of concentrated investing has just gone too far, right? It's there's if it doesn't work for you, don't do it. You don't do something if it doesn't work. And secondly, and I've said this to others, like even if you go to concentrated investing, it's not like a one and done thing, right? If you become a concentrated investor and some things aren't working for you, you should go back to being more diversified. It's not like once you're led into like concentrated investing heaven, you don't step out of it, right? You got to reevaluate your processes all the time.
Mm-hmm. No, 100%. So that's in the way up, and then when you suffer, when you suffer, 50%
watch my handshake here while I'm going to answer this question.
Yeah.
Here.
Yes. I think it's in the afternoon or almost evening where you are, so you're able to have a cocktail for this question.
Yes, that's true.
How do you handle kind of 50% drawdowns then in something like XPEL? How do you handle it emotionally, even physically? Because a lot of people probably are calling you, asking them, they've relied on your conviction for their own, whether they want to admit to it or not. They're probably reaching out to you, like, what are you thinking? What are you doing? How do you deal with kind of, fortunately, unfortunately, kind of being the face of a monster stock from an investor standpoint? How do you go through that?
Ironically, I'm not the face of XPEL. I mean, investors have such a short memory that whoever posts the most about a stock in the last 3 months on Twitter, on X, or MicroCapClub, or now like deface, congratulations, you've taken it over, right? So, which is fine with me, right? I mean, I really don't want to be like the face of of XPEL. I don't want to be, I'm like, I tell people, I've written people, and maybe this is why I don't get too much direct contact about XPEL. It's like, I am not your emotional support investor, right? That is not me. Make your own decisions, right? And if you can't make your own decisions about any given stock, don't own it. Don't own it, right? So, but look, at the moment, if I walk into like a room of like fellow microcap investors, because of my position in XPEL, I am probably, admittedly, like the investor who's made the most money in a single stock, right? More than like 50 million. But because of the XPEL drawdown, right, I'm also the investor in the room who was like lost the most, like unrealized gains reversed, right, which is about 50 million, which honestly, I find both like amusing and humbling, which I'm glad. I think we all need to be like a bit humble when we play this game. But look, I was investing for 20 years prior to XPEL with plenty of drawdowns. Others can think of me, if they want to think of me as XPEL guy, but that's not how I see myself, right? My wife, Tala, also, like in 2023, looked at every previous XPEL drawdown. So like intellectually, I was prepared for the latest one. And if stock corrections like freaked me out, we would have blown out of XPEL or MasterCard or whatever like years ago. Like I've long recognized that like success in investing, it requires like substantial percentage drawdowns that first would be like, for me, would be 5 figures, then 6 figures, then 7 figures, and now 8 figures. And if I'm lucky, and I'm going to emphasize the word lucky, right? If I'm really lucky, someday I'll experience a 9-figure drawdown, right? So, because let me paraphrase like the famous Billie Jean King quote, right? Drawdowns are a privilege. It only comes to those who earn it. And I really believe that.
No, I love that. So you're managing the family office with your family.
Yeah.
And I'm just curious, I know your wife and son are heavily involved in the investing side, and I think that's pretty cool.
Yes.
What's that like? How do you make investment decisions, as a family?
Well, it's a wonderful experience, like working with your family, right? It's natural to me since I worked with my mom and dad for years, and now I'm working daily with my wife and my older son, purely on investing, as you said. And I have to say, I'm very blessed that I started dating my wife like during orientation week in college, right before any kind of success, right? And my wife Chala, she's more analytical than me. She's more emotionally even keeled. She's more mathematically gifted, right? Her job history is working with like mutual fund directors, and she serves on nonprofit boards. So she understands like group dynamics better than me, which is like very helpful, right? I almost immediately go to like Shakespeare's. The first thing we do, we kill all the lawyers. And then I usually follow that up with like the second thing we do, let's kill all the committees, right? So, there's a fine line between creative and crazy. And Sala, my wife, she keeps me on the right side. So, currently, I am responsible for sourcing new ideas, right? So I'm the one who like initially just spotted hype, for example. Like Evan, my older son, he does most of the initial legwork. He'll do the first interviews, and he'll do the modeling, right? He's young, but he worked for a hedge fund during college and after graduation, so he's got good skills. Chala also does some interviews and special projects too. And I also work like a long-standing positions and more promising new ideas. So everybody voices their opinion, right? Everybody voices their opinion. But, honestly, for now, I make the final call, right? I make the final call, like deciding which stocks and what size are appropriate for the portfolio. So, yeah.
So you make them believe they have some authority. No, I'm just kidding. No.
They I'm looking forward to the time, and I also have a younger son, and we'll see what he wants to do in life too, right? But it's a takeoff of an old Buffett line, and I'm waiting for the moment it becomes, instead of like Hirschman and son, it becomes like Hirschman and father, right? It's that's my goal. And I know Evan and my younger son, if he does investing, they're going to have different styles. They're going to have different approaches. And my job is to, as a employer and a father, is to help them develop into the best investor they can. And if they don't want to do investing, that's fine too. Um, it's one of it's wonderful as making money is, and people's like, oh, making money is overrated. Look, when you can use the money to have like family experiences like we have, it's remarkable.
That's excellent. Now, I think we'll take some questions from the audience. Just as a reminder, everybody that's online here, you can put your questions in the Q&A, click that button and add them there. One of the questions, how many positions do you hold? Like and how do you think about the weightings of each? I mean, is it 10 positions, 50? How do you think about that?
Yeah. We are very concentrated in the top 8 positions, but we actually hold over, believe it or not, over 70 stocks, right? But 50 of those stocks could total to 100 basis points. And there's something about my brain, and it doesn't apply to Chala, it doesn't apply to our son, Eben, but my brain works better when there's some ownership involved, right? So I tell management teams that we enter stocks like an old man lowering himself into a warm bath, right? It isn't quick, it isn't pretty. So obviously XPEL is a very large position, but it's less than 50%, right? Just because other things have done very well too. And one of the other things that sort of influenced us in terms of position sizing is also just just taxes and an understanding that when you sell something that's appreciated a lot, and you have to take the net returns and reinvest them, whatever that 75% or so that you reinvest has to grow at a faster rate just to catch up to that pre-tax return you would have had in something you didn't sell, right? So we're very conscious of how taxes affect the overall returns.
Here's a good question. How did Jason spend his time on investing back when he was still working full time? How did he screen back then? What's different about how he spends his time today on investing now that he's full time versus back then?
Well, honestly, I like to joke that I had 2 full-time jobs, right? Being a full-time investor and also being like a full-time businessman. I think one of the reasons why I developed in part to become a longer-term investor is that quite simply, I didn't have the time to monitor so many stocks or to watch things turn over stocks so rapidly, right? So my business life, in essence, pushed me into being more of looking for opportunities that could just require less turnover. But look, there's a price you pay. There's a definite price you pay. Like I mentioned, I met my wife orientation week of college. I had my older son, Eben, was born in 1999. So I was juggling being a full-time businessman, being a full-time dad, and being a full-time husband and a full-time investor. And everything sacrifices a little bit, including your family, right? I have more memories of raising my younger son than I do my older son as a young father, which is honestly a price one pays.
We had a couple questions talking about how since you're the idea finder of the family, how do you source ideas in general? Like, is it through screens, watch lists? How do you go about finding ideas?
There's no magic way for me to find an idea, right? I've tried screens, but if you screen for something excellent, like high ROIC or high ROE, most likely those are already found, right? So sometimes you go to the reverse screen, you look for something that is just a low price to sales that's not making money, and you're looking for inflection. A lot of it's just going through doing it the old-fashioned way, right? Just looking at every time a stock comes out and releases an earnings report, right? We did that for a little while in Canada. I'm doing that in Sweden. The other thing is also to look for sort of weird situations, like maybe just new CEOs announcements, right? You do a Google alerts for that, and I find that sort of just it's an initial way to find a possibly interesting situation that may develop between now and the next 2 years as this fresh CEO make some changes. But there's no magical way of doing it. I will say that having like 25 years worth of experience, your brain just like subconsciously picks up opportunities that, like, let's say, like a new investor wouldn't necessarily see, like with hype, right?
How has your kind of what you look for and what you like to find, how has that evolved? I'm sure there's some areas that, or some investments you obviously made 5-10 years ago that you would probably never invest in today if you were looking at it today, and kind of vice versa. Are there some characteristics or ideals that you've changed your mind about when it comes to the types of business?
I've actually found out that I think one of the phrases that has possibly lost me the most money in terms of an opportunity cost is Buffett's circle of competence, right? I think it's so easy to say, my circle of competence is this small circle, and anything around it, I don't look at, right? And of course, there are a few exceptions to that. Like, so I don't look at biotech stocks because I just don't have, it's a lot of technical ability. But I think a lot of smart people have the ability to really widen their circle of competence if they spend a day, a week, a month just analyzing a stock in an industry. So I'm actually, as I've gotten older, I found out that I'm trying to be much more open to ideas, right? Even if they come off as being, I know nothing about it, right? If someone intelligent who I trust and who's done well is like brings up an idea with me, I really try to like listen now. I don't try and just like close it off just because, what do Canadians know about like software roll-ups, stick to your maple syrup, so as I've gotten older, I've gotten softer in some ways with defining like where my limits are.
Well, kind of switching topics. I know you're looking more at Europe, obviously, and
But now,
now that you've kind of dipped your toe or foot in the water over there, are there some differences you would say overall that you can kind of broad brush, or differences for European companies versus over here in the US and Canada?
I think um, uh, I don't know whether I have like really. I've been looking at like Swedish and some European companies for like 2 years, and I don't want to fall into the quick and easy stereotypes that Americans have about Europeans or Europeans have about Americans, right? I don't want to, the old air conditioning jokes that we see go around and things like that. I don't want to do like the investing equivalent of that. Um, what I will say is that particularly in Sweden, I find the management teams to be more open. And I'm not talking about like giving away things they shouldn't give away. But if there's a problem, if if something is challenging, the competitor is challenging, they'll tell you, right? They'll tell you. Like American management teams, you ask them like about like a competitor. Either oh, we don't want to talk bad about our competitor, or they just won't. No one would ever admit that a competitor is like eating their lunch, which you will see like in Sweden sometime, which I find is amusing.
This is a very open question, but like, how do you decide when to sell?
It's you're
What
asking the
would be the top
guy.
2 or 3 reasons?
You're
I
asking
guess
you're
I
asking
imagine.
you're asking the guy who just has unreversed gains of like almost like 30 or 40 or $50 million in XPEL. So I don't know actually whether I I, sh- I should be the one to answer that. Look, uh, you know, people ask me that question, right? Because they look at me and they say, this guy has done, he's held on to so many multi-baggers, right? Whether it's in MasterCard or whether it's XPEL, I have like Aries Management 10 times, and all these. Okay. And like they want like a formula, right? They want to know, like, tell me what I can input into my computer to like alert me that I should sell. And the game isn't like that, right? You just have to know your companies, you have to know your management teams, and you have to sense when things go wrong. Like with XPEL, like I made a mistake in not trimming it like a couple of years ago, right? I trimmed it some, but I should have trimmed it more aggressively. But I look back at it, like I've studied it, I've analyzed it. Like, what did I do wrong? Like, what did I miss? And anybody who like is superficial can just like, well, you idiots, you should have looked at the multiple that it was trading at and known that 10 times sales, you should always sell, right? But those rules don't always work, right? What I missed was how much slower XPEL started to act as they got to be a much larger corporation, right? And COVID sort of hid that a little bit. Like decisions that they're doing today in the old XPEL of like 2017, 2018, 2019, they would have started doing in like 2022. It's just such a slower moving organization. And that had like ripple effects on their growth rate and on obviously on the valuation. So it's always a game that you're learning, and you never get it right when you sell, and you never get it right when you buy. And really, the question should not be like the question should not be like, when do you know to sell? It should be like, when do you know to trim? And then you can always just, it's a question like, should I trim more? Should I trim more? Or should I trim more? Right? It shouldn't be just binary, like all in or you're all out.
Mm-hmm. So when it comes to your investing knowledge and your business experience, it's the old Buffett line again, but how has been being a small business owner, how has that impacted your investing?
It's you always want, with my small business, right? We didn't have opportunities to reinvest capital back into the business, right? It was we had a very large customer which was dominant. So in essence, like you look for some of the qualities that you didn't have to enjoy, right? I was looking for these companies that could have some in microcap sense, like some kind of moat, right? Which is a much milder moat. Anybody who uses like moat in microcap is I mean, come on, but there's advantages, there's leads, there's not really like moats. So that was really sort of important. I'm looking for some of the qualities I just didn't get to enjoy in my own business. I'm sorry. You say the question one more time. I know there's
it was
something
mainly
else.
as a small business owner, were any of the experiences applicable to your investing that helped you with your investing?
Yeah, I mean, a lot of it was just I mean, just the daily things like just doing like inventory or doing sales or doing marketing and just picking up little nuances that if you see someone not doing it right, in another business, right? It like kills me, like having like looked at inventory and dealt with like inventory for so long in my own small business, when another like company doesn't manage their own inventory properly, and always I mean, it's such a large working capital component, and you end up putting people in charge of it who are like making like $16 an hour. And it's absolutely crazy. And yes, they're like controlled by a little computer, which they find workarounds on. So it's just little observations or sensitivities like that just like that affect my approach.
Is there anything about your kind of personality that you think make you kind of an above average investor, or maybe it's just an untrusting individual? No, I'm just kidding.
No, it is.
What is there anything personality wise that you think is an advantage?
Yeah, my personality, and partly it's derived from being my parents' son, is that I am, there's also a line between like stubbornness and determination. I think every small business person who's like successful is determined, and every small business person who ends up being a failure ends up just being stubborn. And a lot of it's just how it worked out. But yeah, I am a things just don't bother me as much, like criticism or people having a different point of view. It really doesn't it doesn't bother me. And my wife would say otherwise, but it doesn't bother me enough to like make me act in a unintelligent way. Maybe that's the better way of doing it,
That makes sense.
right?
In your, you mentioned you have 50 positions that probably make up 100 bips. You know, it's kind of like your
Yes,
tracking positions. Would you
absolutely.
say that a majority of the positions that end up being real positions come out of that bucket? You know, that you're kind of, you're watching them, you're looking for a catalyst, or you're looking for an acceleration, or you're looking for something that will trigger that. I mean, it's just valuation. Stock just needs to come down. I don't know. Like what's the normal cadence of something becoming a real position in the portfolio? Does it enter that realm first, and then you're just watching for a specific moment or valuation to get you to act?
A lot of it just, to get it in there and just to start paying attention to it more. It's not just also about not just valuation, but just to like force
Mhm.
my brain to look on it for whatever reasons. If I have, and maybe this goes back to being a small business person, like if I don't have any skin in the game, I just don't care. And maybe it's also like the people, like some some parents are remarkably focused and of course love their own children, but couldn't give a damn about some other kid, right? It's like I care about my children. I don't necessarily care about your other people like stocks, which are like outside the portfolio. It's just not. It's just the way my brain works. I mean, um, um, so yeah, I mean, there, I think usually is I end up, buying a position like XPEL, right? I owned it a little bit in 2014 or so, right? Um, and just end up watching it a little bit more, right? You end up pulling the quarterly report then, like the actual day it drops as opposed to like 6 weeks later, right? You end up talking to other investors a little bit more about it because you own it. It's like talking to a management team. If you talk to a management team and you say, I don't own the stock versus saying, I have a starter position in your stock, they kind of like you a little better, right? Um, and so it's just an easier conversation. I think the mistake I make sometimes is that I don't turf out some of these single A players fast enough, right? You just end up with an accumulation of a stock. And then once every 17 months, you're like, why do I still own like 100 shares of this stock, right? And the worst thing is like when you open that up and you're like, God damn it, it went up 4 times, right? And you didn't, for whatever reason, you didn't even notice it, and you're supposed to notice it, right? But no, my brain's just wired a certain way, and you have to like play to the way your brain is wired,
Mhm.
right? And I think a
I,
lot of investors don't do that. They think that this is the golden way you're supposed to invest. Like know yourself and play to your strengths.
yeah, I think I think it's an interesting topic because it's one area that I've evolved to is just my willingness and ability to kind of just take some small, very small positions. And I think part of it might be a little bit because of the capital increasing, you know, where hey, it takes you a month to buy 1% of the company anyway. So you're kind of forced to let a position kind of grow slower, which is more natural when you're building conviction anyway. And I feel like I have become somewhat of a better investor because of that as well. Just letting these things percolate and take time because it's going to take time to build the position anyway. And I feel like that fits more of the trajectory of how investing in this space probably should be done anyway. And I used to believe, you know, unless you're putting 10% of your money into something, you know, day one or whatever, in 7 days, whatever that period of time is, like you're not, it shouldn't matter. It doesn't matter. And that's just not reality.
Right. I mean, one of the things about microcaps is that usually time is not your friend in most microcaps, right? Because they are either like losing money, or even if they're breaking even, they're diluting you aggressively through warrants and stock options and secondaries, right? So it, partly like even in these tiny little positions, I'm trying to get into microcaps where time is actually my friend, which is a really small percentage, unfortunately. I
Very
think in the
small.
U.S. and Canada. Yeah.
Yeah, it's brutal when you think about kind of all the positions that you've owned over the last 10 years in microcap and how many you genuinely would like more, you know, looking back even a year or two. You know, it's like time
Yeah.
just the great filter of,
I mean,
you
and
know,
this is one of the things we talk about. Like we always get up and when we trying to like introduce microcap to someone else, it's like there's 10,000 microcaps out there. That look at that. It's an amazing universe, right? And then uh, you're like, well, how many of them are really interesting? And you're like, well, 73 of them. Or some small number, right? I'm exaggerating there, but that's the other opportunity, right? That 9,000 of them that you've rejected. That hopefully, what's going to happen is that one of your friends in your network has not rejected it and is going to alert you, when it actually turns into something a little interesting, right? And that's why it's so important to build network.
Yeah. I mean, what you find too is in every successful situation, it ultimately does attract a lot of different flavors of investing. When it's cheap, it
Yeah.
attracts value. When it's growth, it attracts growth. It
Yes.
eventually kind of pulls people into it, into the interest orbit around the company.
Yeah. Yeah.
Yeah. One of the other questions that came up was just kind of like the power laws of returns, and you've seen it. I know you have in your portfolio. When you think about and kind of looking back, you're a little bit kind of like Ben Graham with Geico, where you had one investment that
Yeah.
equaled a lot of returns in the portfolio. So I'm curious how you think about those power laws in your own, like how much of the wealth was created from one stock or the top three versus all the others.
The look, there's a substantial percentage of the returns that were generated from XPEL, right? So one could argue that the money or the million and something that went into XPEL, right, was generated from other things, right? So where does it really start? I'm actually not a huge fan of the slugging percentage argument that people make, which is kind of ironic because I'm like the example of like slugging percentage success. I think first of all, there's a famous like graphic that a lot of investors use of like Ted Williams, and he's standing at the in the batter's box. And you see all these little squares, all these little areas where like his batting average, like his percentage is high, the other percentages are low, and therefore like you wait for your pitch, and of course other people then use the metaphor, the slugging and things like that. And there's actually I think it was either Caltech or like Stanford grad student who just like loves baseball, and he looked, and of course he couldn't go back to Ted Williams, but like modern baseball, he looked at every like left-handed hitter, like where were they actually their successes and where were the failures, and concluded that like Ted Williams, that little pictogram has to be wrong. It has to be wrong. Even that Ted Williams, the differences between the averages could not be that dramatic, right? It just, Ted Williams has it wrong. And I really do think that batting, if you also look at like the major league stats, yeah, people with like very high slugging percentages, they tend to, a number of them have pretty good batting averages too. Um, so, and investing, right? I mean, yes, like things like XPEL are important, tremendous slugging returns, right? But if I had struck out, right, if I had just like was only like aiming for like slugging percentages like years earlier, my capital would be so much smaller, right? Possibly. So, the advantage of I made a lot of money at XPEL, but I was able to make a lot of money at XPEL still with like a 15% like position, right? Because my batting average, in combination maybe slugging percentage, but my batting average is fairly high, right? So I had the capital, therefore, really to take advantage of when I swing and I hit, right? Even if it's a triple, even if it's a three bagger, not a 10 bagger. Now it's a lot of money in dollar terms. So I wouldn't underestimate batting average.
Yeah, I think that's a good point, and I agree. I think that analogy with Ted Williams is probably one of the most overused ones. And when you think about baseball too, people forget about there's offense and defense, and you can be a 250 hitter, but if you're the best shortstop in the league, you're still going to get paid a lot. And so there's position players, there's defensive reasons you have a player. It's not just offense. And I think that's kind of an interesting analogy to think about
Yeah,
too when
yeah,
it comes to the portfolio.
yeah. And I think if you have a very low batting average, you got to analyze your approach, right?
Mhm.
Even if you've had a couple great successes, because uh, to me that's a sign that you're probably not investing in a sustainable way.
Well, and I think the batting average too is important because that comes back to really kind of the valuation when you're buying a position too, right? That you're buying it at least a good valuation initially. you know,
Yeah,
that
yeah,
it
yeah, yeah.
limits the downside. At least, you know, if you're wrong, it might be a single instead of if you're wrong, you're going to lose 100%.
Absolutely,
Yeah.
absolutely.
Well, I think we hit most of the questions that were given to us. I want to thank Jason for giving us the time today. And really was an honor to have him on here and get to fire some questions at him and get to learn more from a really, really great private investor. And if you're not already on the community, you know, Jason's on there as well as a whole bunch of others. And hope to see you on the next conversation. Thank you.
Oh, thank you. Thank you. Really appreciate it.